A banking agent is a retail or postal outlet contracted by a financial institution or a mobile network operator to process clients' transactions. Rather than a branch teller, it is the owner or an employee of the retail outlet who conducts the transaction and lets clients deposit, withdraw, transfer funds, pay their bills, inquire about an account balance, or receive government benefits or a direct deposit from their employer. Banking agents can be pharmacies, supermarkets, convenience stores, lottery outlets, post offices, and more. Globally, these retailers and post offices are increasingly utilized as important distribution channels for financial institutions. The points of service range from post offices in the outback of Australia where clients from all banks can conduct their transactions, to rural France where the Banque Crédit Agricole uses corner stores to provide financial services, to small lottery outlets in Brazil at which clients can receive their social payments and access their bank accounts. Banking agents are usually equipped with a combination of point of sale, POS, card reader, mobile phone, barcode scanner to scan bills for bill payment transactions, personal identification number, PIN, pads, and sometimes personal computers, PCs, that connect with the bank server using a personal dial-up or other data connection. Clients that transact at the agent use a magstripe bank card or their mobile phone to access their bank account or e-wallet respectively. Identification of customers is normally done through a PIN, but could also involve biometrics. With regard to the transaction verification, authorization, and settlement platform, banking agents are similar to any other remote bank channel. Local regulation will determine if financial institutions are allowed to work through retail outlets. Regulators generally determine what kind of, if any, financial institutions are permitted to contract banking agents, what products can be offered at the retail outlets, how financial institutions have to handle cash transport, know your customer requirements, consumer protection, and other operational areas. Rationale for banking agents. Banking agents help financial institutions to divert existing customers from crowded branches, providing a complementary, often more convenient channel. Other financial institutions, especially in developing markets, use agents to reach an additional client segment or geography. Reaching poor clients in rural areas is often prohibitively expensive for financial institutions since transaction numbers and volumes do not cover the cost of a branch. In such environments, banking agents that piggyback on existing retail infrastructure, and lower setup and running cost, can play a vital role in offering many low-income people their first-time access to a range of financial services. Also, low-income clients often feel more comfortable banking at their local store than walking into a marble branch. Banking agents are the backbone of mobile banking, i.e., performing transactions over a mobile device, most often a mobile phone. To enable clients to convert cash into electronic money and vice versa, which can then be sent over their mobile phone, clients will have to visit a branch, automated teller machine, ATM, or banking agent. Especially in remote and rural locations, where cash is still the most important way to pay and transact, a mobile banking service is dependent on banking agents to enable clients to effectively use the services. Transaction process. For the client, there is no difference in accessing his or her bank account at the agent or in a branch or at an ATM. However, besides signing a contract with the financial institution it will be working for, the banking agent also has to open a bank account at the same. In addition, the store has to deposit a certain amount of cash into that account, which will serve as the banking agent's working capital. In many cases, rather than asking the agent to come up with the cash deposit, the financial institution will extend the store a credit line. The size of the credit line is normally not standardized, but adapted individually to each agent depending on its size, the expected volume of transactions, and how long the agent has already been working with the bank. This is how the credit line will be used during each transaction. Client withdraws money, cash out, transaction agent account is credited in same amount. Client deposits money, cash in, transaction agent account is debited in same amount. In case the agent's credit line had reached its limits, and the agent's bank account does not have sufficient funds to cover the received funds, the POS will block and can only be deblocked if the funds have been deposited in the next bank account. The transaction process for banking services using a bank card is simple. An existing bank client presents his card at the agent and requests a specific transaction and the amount to be withdrawn, deposited, or transferred. The agent selects the type of transaction on the POS device or personal computer, enters the amount, swipes the client's card through the device, and lets the client enter his PIN. A general packet radio service, GPRS, dial-up, or satellite communication connects with the bank's server to authorize the transaction. Once the transaction has been authorized, the device prints the client's receipt. Banking agent setups. There are principally three ways that banks can set up their equipment and marketing material within a store. Cashier. When transaction volumes are relatively low, a banking agent's staff may process banking transactions in addition to their normal sales. The banking equipment is located behind the store's general cashier. Posters and marketing material may be limited to a small display next to the FPOS terminal and a small sign outside the store. Stand. If transaction volumes justify it, a banking agent may set up a stand within a store with dedicated staff. Some financial institutions prefer the setup since clients do not feel as much as banking in a store and the bank's brand is much more visible. Dedicated store. A banking agent may set up a dedicated store which is similar to a mini branch, i.e., a small shop with around 1 to 3 tellers, but transactions are processed by non-bank staff. In most cases, the store will be branded by the bank to actually win the trust of the rural dwellers. Experience with banking agents. Pioneering banks, microfinance institutions, and mobile operators started to experiment with banking agent networks in various countries around the world such as Brazil, Peru, Colombia, Kenya, Mexico, Pakistan, the Philippines, and South Africa. Latin America is the region with the strongest development towards banking agents. Here governments concerned about expanding financial sector infrastructure have adjusted regulation and are providing incentives for banks to reach new geographies and new client segments through banking agents. Brazil is probably the most developed market where banking agents have significantly increased financial system infrastructure. 74 institutions are currently managing around 105,000 points of sale in Brazil that reach all 5,561 municipalities. Within only 5 years, the banking agent network facilitated 12.4 million new bank accounts, and today the network comprises 56% of all points of sale in the Brazilian financial system. Financial institutions in other Latin American markets such as Peru, Colombia, and Mexico have started to learn from the Brazilian experience, adjusted their regulation, and established their own banking agent networks. Pioneers in other regions can be found in Kenya, Mongolia, South Africa, and the Philippines. Agency banking was introduced for the first time in 2013 in Bangladesh, with the aim to provide banking services to economically backward and underserved populations, especially those who live in rural locations and very far from banks. Research by the World Bank states that according to a Global Findex report 2021, released in 2022, the global population of approximate 1.4 billion people are still unbanked. This, 1.4 billion, is not at all a small number. And as history says, agency banking's primary aim is to help the unbanked and underserved populations. That's the reason why the adoption of agency banking was considered by the banks. In this blog, we will discuss what agency banking is, why it is needed, who banking agents are, how it works, the major parties, its advantages, the services, and the use cases of its successful implementation. What is the meaning of agency banking? Victor was a farmer in a village very far from the city, and his son had started his high school study at a boarding school in the city. One day his son got sick and had an urgent need for some extra cash. Victor wanted to send him the money immediately, but there was no bank in the village. Victor did not have extra cash other than the amount he wanted to transfer to his son. So, he felt disappointed and helpless. But then his friend told him that his bank had introduced an agency banking service in the village, available at the nearby grocery store. Victor visits there and successfully transfers money to his son. Agency banking acted as a lifesaver for Victor. So without further delay, let's understand what exactly is agency banking. In layman's terms, agency banking is a service introduced by banks that allows them to offer their banking services without having traditional branches in areas that do not have easy access to financial services. The need and importance of agency banking. Now that you know what agency banking is, aren't you curious to know what led to agency banking? Why did the need for agency banking rise? High operation and setup cost. Setting up a traditional bank in every place is next to impossible. But anyhow, if the bank tries to do it, the costs to set up and operate are so high that it would be a loss-making initiative for them. Agency banking has taken away this burden from the banks, and now they are providing their services regardless of the physical location. Limited scaling capabilities. Traditional banks were not able to extend their services to the areas where there were no banks. There was no way to do that until the people from that area could come to the bank. This made banks miss out on many customers, leading to limited scalability opportunities. With the impact of agent banking and its branchless functionalities, it became possible to extend banking services to a larger population, leading to the increased ability to scale for banks. Low profitability. When there were only brick-and-mortar banks, traditional banks, they could only cater to the customers that visited banks. Then when online banking started, they could cater to customers who were already associated with traditional banking and had their bank accounts, but in the online form. So, their profit was limited to these customers only. Hence, with the arrival of agency banking services are reaching every nook and corner, and with more customers, more profit is an obvious byproduct. Lack of agility. Traditional banks are less agile and flexible in terms of adapting to change and catering to customer needs and preferences. But the customers look forward to fast and more convenient services, which is a challenge for the traditional bank to keep up with. On the contrary, by making several services available for agency banking, traditional banks can extend their services quickly and effectively to their customers, especially those who reside in remote and underserved areas. Owing to these challenges in traditional banking, the importance of agency banking rose, and today it is accepted and utilized widely by almost all banks to extend their services. In simple words, a banking agent is a third party who provides banking services on behalf of a bank to customers. The banking agents provide these banking services in remote, unbanked, and underserved areas. Generally, the small shops, grocery stores, gas stations, or postal services in these areas become the banking agents with a bank to provide various banking services like cash deposits, withdrawals, balance inquiries, and many more. The banking agents operate in different ways, such as some agents provide services by going door to door with their mobile phones, tablets, or MPOS machines. Some agents do the same, but from a fixed location in areas that are within easy reach of the customers. Thus, banking agents are a vital part of the agency banking process. But how exactly does the agency banking process work? How does agency banking work? To provide agency banking services, the banks need to offer an advanced agency banking solution that facilitates a seamless banking experience for the customer and smoother coordination among all the components of agency banking mentioned above. Below are the steps as to how branchless agency banking works. Bank and banking agent come into a contract. In the first stage, the retailer gets authorized as a banking agent by his respective bank or financial institution, and they sign a contract for extending the banking or financial services. Create an M-wallet for agents. After the authorization and contract process is completed, the banking service provider creates M-wallet for the banking agent. This wallet allows the agent to deposit and manage funds electronically. Once the M-wallet is created, the banking agent deposits a prepaid balance in the wallet to begin providing services to customers. The customer opens his bank account. Now, customers can open their bank account and avail of basic services like cash deposits and withdrawals by simply visiting the nearest banking agent with a valid ID. Initiation of the transaction. If a customer wants to initiate a transaction, he can visit the agent and ask for the type of transaction he wants to make. The agent will then initiate the transaction in cash or card, as per customer preference. Confirmation of transaction. Once the agent initiates the transaction through his system, the bank processes it and facilitates the transaction for the customer. And on successful processing, the agent confirms it by assigning a transaction receipt to the customer. Parties involved in agency banking. Now that we know how agency banking works, let's take a clear understanding of the parties involved in the process of agency banking. Agency banking service providers. Agency banking service providers are responsible for managing various banking agents. They are also responsible for operating services, marketing, cash handling, branding, and many more. As discussed earlier, banking agents are the retailers authorized to perform various banking services on behalf of banks and financial institutions. They provide various banking services to customers. Banks/financial institutions. Banks and financial institutions are the hosts that comprise both consumer and agent accounts. These are entities through which the actual cash flow takes place. Super/sub-agents. Banking agents can also form other agents under them and get an additional commission for every transaction they make. This way, these banking agents will be called super/sub-agents. Consumers. Consumers are the end users of agency banking. These are generally those people who don't have a bank account but have access to mobile phones, or those who reside in remote and underserved areas where there are no brick-and-mortar banks. Advantages of agency banking for banks. When the need for agency banking arose, the main benefit that was in mind was extending banking services to the population in the areas where the banks could not establish their branches. Some major benefits of agency banking for banks are: minimized costs. Agency banking is a cost-effective way for banks and financial institutions to extend their services in areas having lower penetration of banks. Due to the agency banking model, banks and financial institutions don't need to set up a physical branch, which reduces operational, infrastructure, maintenance, and other high capital investment costs. Agency banking allows banks to kill two birds with one stone. First, they can save the cost required to set up a new branch, because maintaining a traditional bank is around 25% costlier than managing the network of agents. Second, they can increase profitability by driving business from previously untapped areas. Increase in customer base. Banking agents allow banks and financial institutions to expand their customer base by offering services to a larger number of unbanked and untapped customers. This increase in the number of customers can lead to a significant increase in profits for banks. Similarly, with agency banking, the banks can have a large number of agents under them, which in turn brings more customers to the bank and financial institutions. Better maintenance of asset quality. Banking agents are often familiar with clients and their financial situations, including repayment capacity and stability. This know-how can help banks to make informed decisions when deciding whether to lend money. Hence, the banks can easily maintain the quality of their assets and protect their financial health. Build trust and awareness among the customers. The presence of banking agents in the formal banking system brings a human touch that users find comforting. They find comfort as they can interact with someone they know. This is precisely the reason why there has been an increased level of trust for agents rather than bank branches. With such comfort and convenience, clients feel safe performing all the financial operations they need. Such trust in banking agents encourages their whole community, in a particular area, to utilize agency banking in their regions. Enriched customer experience. Agency banking, also known as branchless banking, allows banks to bring their services directly to users rather than requiring them to visit a physical branch. This convenience has led to an enhanced customer experience, as clients can simply visit agents nearby rather than travel and wait at a bank branch. Users can perform various banking operations through their agents, such as withdrawing/depositing funds, paying bills, loan payments, and many more, just with a formal ID or biometric. Agency banking is an easy platform for users as it delivers various banking solutions for the unbanked population using phones, card readers, POS, point of sale, terminals, and many other cutting-edge technologies for processing real-time transactions. High security. In addition to convenience, agency banking offers top-notch security. Customers can obtain a magnetic chip card or stripe, and a bank PIN, which they can use at the agent's terminal to carry out transactions. These methods of payment are more secure than using cash. Services provided by banks via agency banking. Banks and financial institutions offer a wide range of services through agency banking. The agency banking services include cash deposits. The customers pay in cash to the agent, and the agent then transfers the amount to the customer's account. Cash withdrawals. The customer requests a particular amount of money to withdraw, and the agents provide customers with cash of the same amount. Balance inquiries. The customer asks for the balance in his account, and the agent checks in his system and provides the balance details in written or spoken words. Mini statements. The banking agent can generate a mini statement of a customer's transaction history in a digital or physical copy through the banking system used by them. Account transfers. The customers need to provide basic account information or the phone number of the person to whom they want to transfer funds. Agent bank will do it for them. Customer loan applications. Customers can apply for loans with the help of agency banking. They can get the loan application filled in by the agents. Utility bills. The customer can pay utility bills like electricity, water supply, gas supply, and many more. Customer onboarding. The customers can open their bank accounts and onboard themselves to a particular bank of their choice. Loan repayments. Customers can bring in cash and ask for loan repayments with the help of banking agents without having to pay monthly visits and incur heavy travel costs. Credit card payments. If the customer has a credit card, he can get the payment done from the convenience of his proximity. Registration for different services. When banks have various schemes or new beneficial services to offer, the customers can easily avail of these services by registering through an agency banking service. Successful implementation of agency banking. One of the biggest hurdles banks faced was providing banking services in rural areas. Because to open a bank branch in a rural area, high OPEX/CAPEX, operational/capital expenditure, is needed. However, there's no certainty that the bank would get enough return on investment, ROI. This is one of the prominent reasons why banks fail to reach rural users. Also, rural users have not yet developed a habit of using mobile financial solutions. But now, with agency banking, the banks have reached rural areas and provided banking services to a large section of the unbanked population throughout the world. Here we'll discuss the use cases of the impact of agency banking in a few countries. A study by Statista says that as of 2020, there were around 72,617 bank agents in Kenya alone. This stat makes it pretty clear, there has been a positive impact of agency banking in the country. Talking about financial inclusion, the latest report by Deloitte, the usage of financial products, formal access to financial services, in Kenya increased to 83.7% in 2021, up from 66.7% in 2013. The report also states that today millions of previously underserved people of Kenya use formal financial services daily via their mobile phones. According to Truxn, there are nearly 403 plus fintech startups in Kenya as of 2022. This figure is also one reason for the big number of agent banks in the country. According to the latest study by Bangladesh Bank, Central Bank of Bangladesh, Nearly 7.6 million bank accounts were associated with agent banking in July 2020. This figure represents a year-on-year growth rate of almost 114%, which is humongous. The above figures are record-breaking and evidence enough to show a successful implementation of agency banking services in Bangladesh. And as we know, Bangladesh was the pioneer of agency banking for financial inclusion. The latest study by the Gates Foundation on Global Findex Report 2021, it was found that, in Bangladesh, there has been a 50% increase in the use of financial services in the last decade. Hence it is proved that Bangladesh has witnessed a positive impact of agency banking in this developing economy. According to the unbanked report, it was found that nearly 7 million people in Congo have access to formal financial services. And with the advent of agency banking, the scope of this access has increased manifold, with 25 million people still deprived of formal financial services becoming potential new customers. The report also says there has been a significant increase in the penetration of mobile money in the Democratic Republic of Congo, DRC. This statement indicates that the future of Congo holds extensive financial inclusion. From all the above cases, we see that agency banking has allowed banks to reach more and more populations, which in turn has also grown the economy of these countries. Thank you for watching this video.